In this chapter, we'll be discussing about letter of credit. Letter of credit is also known as LC. It's a very important payment mechanism in international trade, and also for domestic transactions it is used, in which case it is called inland letter of credit. But usually when we say LC, it is about FLC, foreign letter of credit. Okay, it's used in international trade. So let us assume that you are a steel manufacturer and you are setting up a new project for which you require a machine. Now this machinery, say it's available in your city locally. So you go up to this machinery supplier, you talk to him, you tell him his requirement, and he agrees to supply to you. So because both of you are local, there is a degree of comfort in this transaction. Okay. So if it's a cash transaction, of course there is no question of comfort. I mean, we need not talk about it. But even if it is a credit transaction, the seller will be comfortable with you because you are local. He can make some inquiries, with other steel firms whom he knows, and on the payment due date, he can personally contact you. He can come up to you. He can follow up for recovery. So even if you fail to pay, he can consider legal action, which is not expensive considering that both of you are local. Okay, so there is a degree of comfort if the transaction is local. So now imagine that the above machinery which you require is not available in your city. Let us say it's a specialized machinery and it's available only in a few places. Say most of your competitors are purchasing this machine from Louisiana. Now the seller in Louisiana doesn't know you. Okay, he prefers cash transaction. But you say you want credit period. Because if he doesn't give you credit, he will lose that order because you will go to another seller who offers you credit. Okay, so in fact, if he is so adamant that he is not going to offer credit, he may not get any business. So here, in which case he has to be just selling locally in his own city. So as a business strategy, he decides to offer you credit. But when he offers you credit, he's taking a risk. Okay, the risk is that now he cannot make local inquiries about you because you're not near his city. If you do not pay on the due date, really he cannot. He can make phone calls to you, but it's expensive for him to personally come and meet you. And even consider legal action. It's difficult. Okay, because you're not his only customer. There are many other customers in various cities. He can't go up to each and every customer. That will be expensive and time consuming. But still, despite all these troubles, he has to offer credit as a business strategy. Now just imagine he's not even in a different city in the same country. He's totally in a different country. Say this machinery is a very specialized machinery, is available only in Germany, and so for very good quality, and all your competitors in the steel industry are purchasing this machinery. So you are bound to manufacture using that machinery. Otherwise, your quality will be affected. So now the German supplier, this is a totally uncomfortable transaction because the German supplier doesn't know you. He doesn't know your credentials. He is not sure whether you'll repay in time. And say for example, if you don't repay in time, he cannot come up to India and follow up. Okay, say he's supplying to various other buyers across the world in various countries. He cannot go to each and every country in South Africa and Mexico and China. He cannot do it. That's out of question. But to be on the safe side, he has to insist on cash transaction. Pay 100% cash and then take the mission. Okay, but that is not acceptable to you because then you will question, what if I pay and he doesn't send me the mission? Okay, then you have to go and follow up. That is not possible. So in international transactions there is a risk here. Okay, because the buyer and the seller doesn't know each other and they are separated so far apart, follow up of recovery is difficult. So in these transactions, a payment mechanism known as letter of credit has come up. Okay, so why it has come up? Because of the risk of transaction. Okay, because in case of export and import, advance cash payment is risky for both the buyer or seller. Okay, so this mistrust between you and foreign supplier will be eliminated in case of a letter of credit because bankers enter into the picture. So in a letter of credit LC, bankers will come into the picture. So this is how it works. So first of all, the buyer will approach his banker. So the buyer, say for example, I am a buyer. I am importing a machinery. Okay, so because I am importing a machinery, I will go to my banker and request to open an LC. Say this machinery supplier is in Germany. So what my banker will do, he'll open an LC, okay, and communicates this to the seller's bank, say the German bank, say Deutsche Bank, okay, through, we discussed earlier that interbank communication is usually through a messaging system called Swift. So this is usually done through Swift. So then what happens is the seller's bank, that is the Deutsche Bank, will inform their customer, that is the seller, about this LC. So the seller will check the details of the LC, and if everything is as per the commercial agreement and terms and conditions are satisfied, then if he needs any change, then amendment can be requested. Otherwise, if the LC is in order, then what he does, he proceeds to prepare the machinery and the documents and ships the material, ships the machinery. Now what he does after shipping that machinery is he gets a proof that he has actually shipped that machinery. So there will be some documents proof, like say for example the shipping company will give him some documents, and there are various documents which we'll see. So the seller's bank will not go to the port to check whether this machinery is shipped. This is important. What the seller does is that machinery supplier, he'll just submit the documents, the proof that he has shipped the machinery. He'll submit the documents to his banker, Deutsche Bank, but that bank, Deutsche Bank, will not personally go to the port to check whether this has actually happened. Banks, both seller bank and buyer's bank, in letter of credit transactions depend entirely on documents. This is a very important feature of LC. Banks are not concerned about this underlying transaction, whatever it is. They are not concerned about the underlying transaction. All that they require is documents. So what the seller does, he arranges for the documents that proves that he has actually shipped this machine. So for example, there is a document called bill of lading. This is given by the shipping company, confirming that the material has been put on board. So in case of a domestic transaction, that proof will be, say, a lorry receipt or something, okay. And this step is very important, it cannot be skipped. So the exporter, that is the machinery supplier, will present these documents to the bank in order to receive his payment. So once he presents these documents, the bank will check the documents, and if they are compliant, they will send the documents to the other banker, to my bank, buyer's banker. So there are two issues here. One, the seller's bank can immediately credit amount into the seller, or if it is a side transaction, it will be done immediately, or it can also be a use-on transaction where some credit period will be given. Say for example, there is some, say, 60-day, the agreement between the buyer and seller is the payment will be made after 60 days, in which case the seller's bank, Deutsche Bank, will not immediately credit the funds. So Deutsche Bank will send the documents to my bank, the importer's bank, okay. So now the documents are with the buyer's bank, and these documents my banker, so I will go and collect these documents. So once I have the documents, I can go to the port and receive and get because the shipment might have already arrived, I'll go to the port and collect the machine, okay. So this is how a transaction works, and after the period of 60 days, I'll make the payment to my banker, okay. That is how LC works. So let us see some terms here in LCs that you have to be aware of. One is packing list. Packing list is a list that informs the customs authorities and even the customer and government authorities, all transport agencies, that what are the contents of this package. It is an important document that should be a part of every shipment. So what are the details of this shipment? So the details like the nature of the goods, what is inside this package, and the measurement, weight of goods, and basic details, okay. Then there is an AWB, that is an air consignment note or air consignment bill. Waybill. Airway bill is a receipt issued by an international airline carrier that serves as an evidence that the goods have been shipped, okay. So this will be make sure that the good has been received by the airline carrier. Then bill of lading is similar to airway bill, but it will be issued by a shipping company. The shipping agency, it is a proof that given by the shipping agency that the goods have been put on board. Then there is something called inspection certificate that certifies that the goods have been inspected and meet quality standards. So what usually happens is that the buyer there are some inspection agencies, outside agencies, that perform inspection for a fee. So I, as an importer, can appoint some agencies. I pay some fees to these external parties and get the material inspected. So at the request of me, they will check before shipment, they will get the materials inspected. Then there is something called certificate of origin. This is required by the customs authority, right, for the purpose of imposing import duty. So based on the country, they'll have various import duty tariffs. So that will be the purpose of certificate of origin. Then there is an invoice document that will be provided by the seller to the buyer. It is also known as export invoice or import invoice, a commercial invoice. It is used by the custom authorities again to evaluate the purpose of transaction for the purpose of taxation. Then there is an insurance policy. Usually when goods are shipped by say shipping or airlines, because there is a risk of loss in transit and damage, usually goods in international trade are insured. So insurance policy will certify that the goods transported have been insured. So letter of credit is a normal term which we use in day-to-day terminology, but the actual term is documentary credit. Letter of credit are documentary credit. So as we discussed, LCs deal only in documents, not goods. So the idea in international trade transaction is to shift the risks from the actual buyer to the bank. Okay, so here what we are doing through this LC transaction is we are getting the bankers into picture. So now the advantage for both the buyer and the seller is, so this LC is like a payment undertaking given by a bank to the seller. Okay, so what happens is the bank is saying that in case that particular buyer fails to make the payment, bank itself will pay. Say for example, I am the importer and I am importing goods through LC. I have got the goods and say the period is 60 days, use on period. After 60 days I have to make the payment and I fail to make the payment, in which case my banker will make the payment on my behalf, and then subsequently it will follow up from me for recovery. But the transaction will not stop. The payment will be made on the due date by my bank to the foreign bank. So that is the advantage of LCs. Okay, LCs are not skipped by banks because that's a question of reputation. In case an LC get divorced and the payments is not made by the bank, the reputation will be lost, and in further customers will not be, foreign banks will not be willing to accept LCs from opened by that bank. Okay, so LCs are very prompt in payment by banks. Subsequently, if the payment is not made, they will follow with the respective customers, right? But for the foreign bank, it will be made compulsory. So letter of credits are usually irrevocable, meaning that the terms of LC cannot be changed once the buyer and seller agree. But there are also something called revocable LCs, in which case changes can be made. So in LCs, there are two terms you have to remember. One is DP and DA. DP means documents against payment. So this is like cash against documents or cash on delivery. So it means, so when the collecting bank hands over the shipping documents, okay, this will be done only when the importer has paid the bill. So I am an importer, I am getting the machinery, I am importing the machinery. First I will make the payment, only then the bank will release the documents, the shipping documents. Then I will take the shipping documents to the port and collect my material. Okay, without payment, I won't be given the permission to take possession of the material. So this is documents against payment. But there is something called document against acceptance, DA, where the exporter will allow credit to importer. Okay, that period of credit is known as usance period. So then I will go to the bank, collect the documents. Without paying money, I will get the material, and on the due date I will make the payment to the bank. Okay, now as we discussed, should I not make the payment, fail to make the payment on due date, bank will make the payment to the foreign bank, and the foreign bank will make payment to the seller, and then my bank will follow up with me for recovery of the dues. So what does bank gain through this? I mean, if there are customers who are not paying, so is it not a loss for the bank? So what banks usually do is they usually give it to their established customers, and also they take some margin, usually it's 10% or 20% cash margin. So that risk is eliminated. They also have some securities in case it's a regular customer. So it's not totally 100% risky for banks. Usually they give it to the existing customers who are availing some fund-based facilities. So it's not like the risk is totally 100%. So in regard of LC, you should remember one more term like UCPDC, that is a set of predefined rules established by the International Chambers of Commerce. UCPDC stands for Uniform Customs and Practice for Documentary Credit. So this is used by bankers and commercial companies in most countries including India. So these terms will be used in international trade. Similarly, there is Incoterms, that is a international shipping. There is common terminology to be used by different countries. That's also been developed by the ICC. So these two terms you have to remember, UCPDC and Incoterms. So in this chapter, the questions you have to be prepared are explain in brief what is LC, what are some documents involved in the process of LC we discuss. So what is packing list, airway bill, bill of lading, inspection certificate, certificate of origin, invoice document, all this we discussed. What is meant by DA and DP? Documents against payments and documents against acceptance. Very important question. The difference between them. The key difference is that the time is given. In case of DA, time is given. Usance period is given for payment. Okay. What is full form of UCPDC and what is the purpose of UCPDC?